Hello, everybody. Welcome to the fourth installment of our founder fundraising series about raising a good fundraising process. Just a quick overview about Sparrow and who's putting on this event. So yeah, we're Sparrow Ventures. We're an early stage VC firm that invests primarily in tech that makes life worth living and companies that make life worth living more accurately. And we really believe that the best companies of our generation are purpose-driven, that they have a mission behind them. And we believe that companies that are driven by such a mission will have the best probability at going the distance and becoming proper venture scale companies. The way we kind of define purpose-driven for our purposes and our investment verticals, if you will, we emphasize well-being, work and purpose, and human connection. Those are very broad categories. So we have encompass everything from future of work and sustainability, health, and a variety of other things that we're willing and open to investing in. But ultimately, our general premise is that our founders are working to build a future that we all want to live in. We're a single LP firm funded by Pierre Omidyar, head of the Omidyar network. And the team comprises a series of very talented and experienced former startup operators and founders. And many of us have been founders ourselves. And so, we empathize with the founders and we really enjoy partnering with them as opposed to just being a check. So joined with us is me, Brandon Walker. Sorry, I'm not on the slide. I'm the newest associate on the team. Veronica, as well as Ha, who are three of us kind of coordinated this event. And then our two speakers are Sydney and Jason, and we'll have Vernon come in the second half of the presentation today. And of course, follow us on social, share out the event. We have a couple more events coming in the future. So be sure to come check those out as well and tell your friends. And then I'll pass it off to, I guess, Jason.
Cool. I can share. All right. Brandon, I forgot to ask, how do you want to do questions? Do you want to do them during the presentation, or should I go through the whole thing and then do questions at the end? You're on mute.
Whatever you're more comfortable with. I mean, I think in the past we've just done kind of an open presentation and then Q&A at the end. It's worked pretty well. But if you would like to take questions in the middle, I can message them to you and you can incorporate them in if you like.
But I don't even know if I would see the message. Okay, yeah, let's just do we'll do the questions at the end. I assume you can see my screen?
Yep.
Full screen? Cool, awesome. Thanks, Brandon and Ha and the rest of the Sparrow team for having me. Excited to chat with everyone. So I have a presentation here. We'll try to get through it 15, 20 minutes is roughly the goal. And I call this getting back to work because while fundraising is still technically work, most founders that I know don't want to be fundraising. So I'm going to go through a quick bio and then talk a little bit kind of like fundraising 101. So two questions that typically start at the beginning of a fundraising process, which is how much do I raise? What is my valuation? Then I'm going to kind of go through what does a typical fundraising process look like? And then I have some final thoughts. And then I actually have an exercise that kind of helps get things kickstarted for a fundraising process. So first, a quick background about myself. So I consider myself a serial entrepreneur. I was that kid that was starting businesses, in middle school and even sold a business in high school. But the first business that I raised money for was on-demand food business here in the Bay Area called Bento. For this business, this was a few years ago, I raised $2 million across 4 rounds. My largest round was $1 million. So a lot of the process that I have in the deck was kind of used by myself during that fundraise. And then following Bento, I joined Jason Calacanis and ran his launch accelerator. So did that for about 2 years while I was there, I ran 8 cohorts with 56 companies. Those companies were I was primarily helping founders fundraise. We did 34 follow-on rounds with those 56 companies. On average, those companies raised $1.6 million. And now currently I'm with Foundation Capital, and I run our Scout Investments program. All right, so let's get rolling into it. So first, some kind of fundraising 101. So I'd just like to go through, like, what are the round names that you'll typically hear? And obviously not every one of these rounds you're going to raise, but you'll typically hear these to hear these names. So first off, typically the first round that a founder will raise will be called a friends and family. Usually it's less than 100K. Another early round you'll hear is an angel round. This is usually less than 250K. The pre-seed, typically less than 1 million. A seed round, typically less than 4 million, although this definitely will vary and get larger from time to time. After a seed round, there's a whole bunch of different names: seed 2, seed extension, a mango seed, a super seed, lots of different names for that, and those rounds have varying amounts. And then finally, you get to the Series A, and obviously there's beyond Series A. And typically with the Series A, that's where you're raising $4 million or more. So now with these rounds, there's various legal documents, so I'll quickly go through those. So a common one you'll see is a convertible note. There's not a standard convertible note, unfortunately, but if you Google around, you can find a few different templates. SAFE is also a standard legal document, and the default for this is the YC post-money template, so you can find that. These two legal documents, the convertible note and the SAFE, they're less expensive than a price round, which I'll go through in a second. They're faster. Typically, you'll see these used for angel, pre-seed, and seed rounds. When you're talking about price rounds, there's typically 2 templates of legal documents that founders will use. One is the Series Seed paperwork. Again, you can Google for that. And then with a Series A, there's typically the NVCA template that you can find. The nice thing about a price round is everything converts. So all of your convertible notes, your SAFE, actually converts into real shares. And then typically founders will use a price round for seed and Series A, larger seeds, and then definitely for Series A. All right, so we'll just keep rolling. So 2 questions that typically are asked at the beginning of a fundraising process. So how much should I raise? What is my valuation? So let's tackle the first one first. How much should I raise when you're thinking about this? So first off, I recommend starting backwards. Where do you think the business will be in 18 to 24 months? What is your target for revenue? What size of team do you need to achieve your revenue goals? What is your product going to look like? And so really think about where you need to be. The thing when you're thinking about where you need to be is you need to make sure that you're hitting the appropriate milestones so that you can successfully raise the next round. And so typically talking with other founder friends or with investors will help you make sure that you're achieving the right milestones so that you can successfully raise the next round. In terms of revenue targets, what I am seeing typically today is a Series A. Series A's are being raised around 2 to 3 million in ARR. So that is one goal to think about if you're trying to get to a Series A with this current round that you're trying to raise. Now, the ideal scenario, and most founders can't get here, but the ideal scenario is you target 24 months of runway with any raise. That gives you 12 months of heads down work, 6 months to raise the next round. It always takes you longer than you think, and then a 6-month buffer. Next question is, what is our valuation? And so this is really market driven and definitely more of an art than a science, especially at these early stage rounds. One good rule of thumb that I have kind of seen helpful is 10x ARR. Really, that's only applicable if you have more than 500K of ARR, but again, kind of gives you a general rule of thumb. Every time you raise, you should expect to sell 15 to 25% of your company. So again, you can think about your valuation in proportion to the amount that you're going to raise. When you're trying to achieve a higher valuation, think think about it in terms of degree of difficulty. It's always possible. It's just how much time do you want to be fundraising? And then the question that I often will ask founders is, how much time are you willing to commit to fundraising? How desperately do you want to get back to work? In general, I've seen kind of most of these early stage rounds generally happen between 5 to 8 million. There are certainly anomalies. We read about these on TechCrunch all the time. And generally the way that these anomalies happen, where the rounds are raised at higher valuations than this, is you see a competitive process, a founder getting multiple term sheets. However, I do have to say, raising much beyond where you are currently can be very risky and can lead to challenges later on. Down rounds are definitely something to be concerned about. So when you're actually talking with an investor, what is the approach that I recommend for thinking about valuation? So I recommend a two-pronged approach. So if you're talking to a lead investor, and I'll talk a little bit more about what a lead investor is in a moment, if they ask you what kind of valuation you're expecting, you don't answer. You say, I'm leaving it up to the market. If it's not a lead investor, then you can say your terms. So say, I'm raising at a $6 million cap. I'm raising at an $8 million cap, whatever it is that the number that you expect, because they're typically not going to be setting the terms. All right. So oops, I'm hitting the wrong way. So next thing I want to cover is another thing to think about when you're raising money is to think about the novelty of your business / idea and the traction. I don't know if you can see, hopefully you can see my cursor, so if we start at the left side of this graph, so you've got the novelty on the y-axis here, and so the less novel your idea. So if you're doing an on-demand business, if it's a marketplace, if it's direct to consumer, I would consider that a less novel idea. If, as an example for something that's a little bit more novel, an enterprise AI solution. And then the most novel is, something on the frontier side. So perhaps something in bio or a little bit of kind of some of the space technology that's coming out right now. So that's one axis. The other axis is your traction. So is it just an idea? Do you have a product in market? Do you have significant customer revenue? And so the way to think about this graph is, where is your startup on it? So if you're on-demand marketplace and you're kind of at an idea, not in market, maybe not significant customer revenue, it's going to be more challenging to raise. The expectations on traction are going to be more in order to raise. And so as you kind of come down this, then the amount of traction expectations are less. All right, let's get in and start talking about running an actual fundraising process. So I recommend thinking about fundraising as a sales process. So what does that mean? So just like sales, you're going to start with leads. You're going to get introed into those leads. You're going to do a demo. You follow up and you close. Again, just like a sales process, fundraising is a numbers game. And so we'll talk about some numbers in a moment. One of the most challenging aspects with raising very early in a company's life cycle for a founder is the fact that you're either fundraising or you're not. And having to run a business while fundraising is extremely challenging. And so figuring out how to delegate a lot of the business to your colleagues is something that you have to try to figure out as best you can. I realize much easier said than done, of course. All right, so let's look at kind of the whole process and then in terms of your funnel. So we'll start with figuring out, 150 or so, sorry, I take one step back. So this funnel and the numbers that are associated with this is what I have seen on average helping founders raise. So when I talk about the 56 companies that I worked with, the 34 successful fundraising rounds, this is on average what I saw for kind of the number of investors that you would need to reach out to in order to successfully fundraise. So you start off at the top with a large list of kind of a general audience. So I recommend typically thinking about trying to get to 150 investors. You're going to narrow that this list down a little bit, and so we'll call that 125 folks that you really are trying to target to. Then we're going to go out and get intro requests into these folks. From there, you're going to take first meetings. Hopefully you get around 50 meetings, 50 first meetings. From there, we'll move into second meetings, hopefully around 20. Around 10 folks will go into diligence. And then at the end, we hope to have three of those folks become team members and actually invest. All right, so let's talk about building this funnel. And by the way, I'm happy to make all these slides available afterwards. So first off, when you're thinking about building your funnel, thinking about those folks at the top, I recommend focusing on lead investors. Lead investors are investors that feel comfortable pricing your company. They're going to write the biggest check into the round, and they typically will help you get the round complete, make intros into other investors, etc. So those are the sorts of investors that you want to try to focus on. And where do you find these folks? AngelList is a great resource. There's a tool by NFX called Signal that I found helpful. There's a spreadsheet of VC funds that are at or below $200 million, and you can go to this link, bit.ly/200mfunds, and that'll bring you there. That's another great resource for finding these folks. A tool that I've recently found by visible.vc, Connect, also seems like a good place to find investors, and then Crunchbase, of course, too. And then don't forget Founder Friends. This was a really helpful resource for me when I was a founder, of just exchanging lists of investors with my founder friends and being able to find new folks that way. All right, so you're building your funnel. You've got this list of, let's call it 100, 150 folks, hopefully eventually. How are you keeping track? So this is a CRM that I recommend. You can find a template and make this your own at bit.ly/investorcrm. And this is how I recommend keeping everything organized. So on top of that, I've actually gamified the fundraising process. And so using this template, you can follow along on my on a little game that I built. So I have investors in different stages. So stage 0 is you are researching those investors and you're trying to figure out if they're a good fit, how do I get an intro into them? So that's stage 0. Every investor you put in that stage, give yourself a half a point. Once you request an intro, once you get an email out to that investor, that moves the investor into stage 1, that's another half point. Once that investor responds to you, give yourself 1 point. Hopefully at that point, you're setting a meeting with them. Once the meeting is set, it's on the calendar, you've got a date and a time and everything, that's stage 3, so that's another point. Once you've actually had the meeting with the investor, give yourself another point. Once you get to a second meeting and have had that second meeting, that gives you 2 points. And then finally, if they commit, that gets you 5 points. And so my target is, when I'm working with founders, is to say, get 20 points per week. All right, so you've kind of come up with a large list. You've got it organized in your CRM. Now let's talk about making sure that you're choosing the right sort of investors to go after. So just a few thoughts on folks that you want to avoid. So first, if the investor has invested in one of your competitors, I would avoid them. So the easiest way to think about this is, if you had them as an investor and they came to you and say, would it be okay if we took a meeting or invested with this other company and that would make you feel uncomfortable, then the reverse situation probably wouldn't make sense, and I would recommend not wasting your time. The other one to look at is their fund fully deployed. And so the easiest way to figure this out is, do they have any recent deals? Crunchbase is probably the best place for figuring that information out. The data is not perfect, but it's pretty good. And then wrong target stage, or geo. So target stage, if you're raising a pre-seed or a seed round, don't go after a Series A or growth investor. And then obviously, if you're raising a seed round, don't go after pre-seed investors. Geo is probably less relevant, especially today, but I still think some on the earlier side, there will be investors that prefer to invest in Seattle or the Bay Area or LA or whatever geo. So make sure you're thinking about that as well when targeting investors. All right, so you figured out, you've built your list, you've got it organized, you figured out who the right investors are. So now it's time to try to get intros into these investors. So first thing I recommend is just building up a spreadsheet and then sending it out to any investors that you know, any friends that may have connections, and just ask them, hey, can you put your name next to anyone that you have a connection with that you think you could intro me to? So that's a fast way to figure this out. The other way, obviously, LinkedIn. Make sure any of your investors or founder friends are connected so that you can see who has those connections. We all know that doesn't necessarily mean they know each other, but it's still a helpful signal. If neither of those avenues work, what I have found to be a clever hack to get introed into an investor is to actually reach out to a founder that investor has invested in. Investors love getting intros from their founders, and founders are much more likely to respond to a cold email from another founder. So just asking for advice, asking them to, for a Zoom coffee or something like that, I think could likely lead to them ultimately introducing you into their investors. And so that's been a good way to do it. And then the last thing I'd say is don't be afraid to cold email. The more personalized you can make this, the better. Definitely don't spam a whole bunch of investors with a generic, BCC sort of type of email, but more, I love getting cold emails. I read every one. I know many investors that do the same thing. So I would definitely not be afraid to cold email. And then, of course, keep track of everything in your CRM spreadsheet. All right, so we figured out the best intro path. Now it's time to actually request the intro. So I built a little template here, and again, you can find this at bit.ly/investor intros for this sort of template. Oops. And so a few things about the intro template. So first of all, the more personalized you can make this, the better. Better to do a few of these per day, spend a little bit more time on each of them than trying to blast out a lot of generic ones. The deck that you'll include in this intro request should be a teaser deck. It's enough to get the investor interested, but not enough information to necessarily have them make a decision. The goal here is obviously to get them excited and to take the meeting. You want to prioritize leads. We've talked about that a couple times. My kind of personal life philosophy on things is to try to do a little bit every day. So rather than trying to do 50 of these in one day, I recommend doing 5 or 8 or 10. And again, this goes back to my point system, which is 20 points per week. One thing that you'll often hear is to do these intros in parallel. And I actually think that could be a good idea. I don't have a very strong opinion about it. But again, if you do 5 per day, save up 2 weeks, and then you can blast all 50 out at once. And so the idea behind doing these intros in parallel is that you want to get your first meetings done around the same time, your second meetings done around the same time, and hopefully get term sheets around the same time so that you can really build momentum in the round. All right, so we've got the intros out, we've got some meetings, so now let's briefly talk about that first meeting that you have. So just a few thoughts. So number one, you're in charge. You're the founder. You're the one spending your life building this business, trying to change the world. They're just an investor. Keep that in mind. I recommend setting the agenda at the beginning of the meeting. And the way that I like to recommend founders do this is ask the investor, do you have a preference? I have a 5-minute overview pitch. It will go over things pretty quickly, or I have a more detailed pitch that can go through the marketing, the team, et cetera. And which is your preference for which deck that we go through? I always recommend using a deck whenever you're in these meetings. Even if an investor just wants to, quote unquote, have a conversation, I still recommend using a deck, because the most frustrating thing for a founder after leaving a meeting is realizing that you forgot to hit an important point of your pitch. And so having a deck ensures that you hit all of the important points. Prepare questions ahead of time. The investor likely has a lot of relevant experience, whether themselves or working with other founders. And so at a bare minimum, get some knowledge out of them. Ask them, what would they do? What marketing channels would they do? What sort of tagline do they think might work? You know, ask some questions and see if you can gain some knowledge. Remember to have really positive, exciting, contagious energy. This really matters. Starting a business is a marathon, and you're at the very beginning of that marathon. And if you don't have that positive, exciting energy at the beginning, investors may be concerned that you don't have what it takes to build the business over the long haul. So going back to my fundraising as a sales process, make sure you're nailing down the action items in the meeting, very specific next steps, and then we'll talk about follow-up next. And then lastly, I would say, don't be afraid to ask. You know, this is investors are there to invest in companies. Ask them point blank, what would it take for you to invest in this round? And then stop talking, let them talk. All right, so after the first meeting, a few things. So one tip that I recommend is setting an FAQ to the investor. So what questions are most commonly asked of when you're talking with investors? Put those in an email and send those to the investor you just met. What happens internally is they're going to have to turn around and sell your business to their colleagues, and so they need to be equipped with as much information as possible. One question I get asked a lot is, how do I create a sense of urgency in this process? So I'll give you a couple thoughts. So one, I kind of put this in the okay bucket. So at the end of the month, I'm closing the round, putting my head down and getting back to work. You know, sometimes this works. The more true it is, the more effective it will be. The best way to create a sense of urgency in a fundraising process is you get your first term sheet. You will see investors move very, very quickly once you've got that term sheet. One extra one is we're oversubscribed, decided to open up another $250K for strategic investors, and we'd love to have you involved. So this is kind of using, you know, setting a target round size that's a little bit smaller, and then oversubscribing. One thing to keep in mind is most investors knows these tactics and probably won't change their behavior, but good for you to think about them as well. And last thing I'll say here is never lie. You know, this all lying will definitely come back to bite you. The other thing after you've had this first meeting is sending weekly updates. And so I've got a whole drip campaign that I use to close my round at Bento, and I've got examples of the emails that I've sent again on my Medium. And this is just one example. So it's short, it's very metrics driven, and it's keeping the investors informed during the fundraising process. All right, so hopefully you've had all those meetings, your first meetings, your second meeting. Now it's time for due diligence. So one of the first things that you're going to get asked for is a data room. A data room is really just a Dropbox, a Google Drive, a box folder of some documents. And so one of the most common questions that I get from founders is, what do I put in my data room? So this is what I think you should put in your data room. This is a good place to start. And then the other thing is just ask the investor, say, hey, here's a link to my data room. Here's the 7 or 8 things that are in there. Is there anything else that you'd like me to add to the data room? Like, don't be afraid to just ask that question. And then the one thing I'll caution you on around due diligence is just be careful with references. Investors will often use references to kind of buy themselves time to try to help them make a decision. References really should be used as kind of a final validation. Well, they should have basically chosen to invest in your company, then they check references. You don't want to burn your references, especially if you're an enterprise company, you only have 2 customers. You don't want 10 investors calling those customers. You have to be careful with that. So just be very careful with that. All right, just a few final thoughts, and then we'll get to the questions here. So if an investor passes or does not invest, do not ask them for intros to other investors. This is a negative signal. The first thing that the following investor is going to ask is, why didn't you invest? And so that is not the way you want to start a relationship with a new investor. We talked a little bit about being oversubscribed and using that to your advantage. So this is one of my favorite Naval quotes, you're unfundable until you're oversubscribed. So think about that when you're strategizing about your round. First-time founders generally will fear dilution, and I recommend not fearing dilution. You are trying to build a massive company. How much you own of that, at the edges really won't matter in the long run. Getting to work, solving problems, getting good folks involved, that's what will matter more. Getting to a yes in this process, just like a sales process, is about being persistent but not annoying. It's a very fine line. Just try to make sure you're staying on the persistent line, not the annoying part of the line. The other thing to keep in mind here is that you're building these relationships over the long run, and the first time you pitch an investor probably will end up in a no, but people invest in lines, not dots. So if you keep those investors updated and you start building those lines up and to the right, they may come in at a future time. And so my last bullet here is, how do you start this process if you don't have rich friends, if you can't get that friends and family money? The answer is get traction. And again, that's sometimes a chicken and an egg challenge, but at the end of the day, there are a lot of founders building a lot of companies that have figured out how to get traction. And the amazing thing about traction is the more you get, the less you need investors, and then you're really in the driver's seat. It's up to you to decide if you want to take investors and not necessarily the other way around. And that is an amazing place to be as a founder. So I have kind of it for the prepared point. I'll put up this little exercise here. And again, I'll share my slides afterward. And yeah, happy to take questions if there are any.
Awesome. Thank you, Jason, for that. We have one question coming in from Valentine. So Valentine, if you can unmute yourself and ask your question.
Hello. Can you guys hear me?
Hey, Valentine.
Hi, Jason. Nice to meet you.
Good to meet you.
So my question goes around when you were talking about throwing questions back to the investors. And my question pertains around, is it okay to ask like an investor, like how much they're willing to invest in you, how they work with their founders in the future, what have they built? Because there's this podcast I heard, if you're working with someone that's just built something in tens of millions and then you're looking to build you onto the hundreds of millions or even a billion, like there's this, like you have to choose who you work with, kind of the way I'm thinking of. So is it the right question to ask an investor? And if it is, like, how do we go about asking those questions?
Yeah, good question. So, what questions should you or should you not ask investors? And so, the more I think about it, I think there are almost no questions that I would say are off limits. Asking them about their previous operating experience, asking them how they work with their founders, asking them what is your value add. I think those are fantastic questions to put investors on the spot. And it doesn't always happen this way, but if you can build that competitive round and you get the luxury of choosing your investors, those things matter. And doing reference checks on your investors matters. When you take an investor on, you're taking them on for the life of your company. And so do you want to work with this person for the next 10 years? So it's really important that you do know who you are taking on to your cap table. So yes, I think the way you phrased those questions was excellent, and I highly recommend asking those questions.
Awesome, thank you. Our next question is from Kimberly. So Kimberly, if you can unmute yourself and ask your question.
Hi, Jason, how are you?
Kimberly,
thank you so much. This has been an amazing presentation, and it really puts a lot of insight for me as a founder. So I guess my main question is, if you're a pre-rev company, what's the best way to go about creating your valuation, right? What are some of the KPIs that are used to, or key points to create that valuation, and how do you justify it?
Yeah. So there really are, this is definitely more of the art part of valuation. If you're pre-revenue, there's essentially nothing to help you figure out what your valuation is. So the way that I typically recommend this to founders is to think about this on kind of a degree of difficulty. So the lower you set your valuation, the quote unquote easier it is to raise your round. The higher you want your valuation, the longer you're going to need to take to raise that round, the more investors you're going to need to talk to. So, you know, I see kind of these pre-revenue kind of initial rounds. I've seen them as low as, you know, a $3 million valuation. And so, look, like, is that pretty low? Yes. But look, if you can get 300K in or 400K in, and, you know, the investor's like $3 million valuation, like it's a bargain. And it's like, okay, like, yeah, you take some extra dilution, but you get back to work faster. And so that's how I would generally think about it, is, you know, how fast do you want to get back to building the product and working on the business?
Thank you, Jason. Our next question is from Ty Calloway. So Ty, please unmute yourself and go ahead and ask your question.
Okay, awesome. Can you guys hear me?
Yep, we can hear you, Ty.
All right, thanks, Jason. Yeah, so the question I had was, I read somewhere where only 3% of all startups in the country are pretty much VC backed. And we all know the disparaging number of 1% of Black founders are VC backed as well. So I'm like, okay, 1% of that 3% is pretty micro. So should we focus more on alternative measures of funding, such as like going through government or crowdfunding and things like that? Because it sounds like, you know, in order to get an investment from venture capital seems sort of like a lottery or a crapshoot for us.
So if I were to start a company, another company today, I would actually, which is probably counterintuitive, I would likely try my best to not have to raise any outside capital. I would try to figure out, how can I get customers? How can I get revenue? How can I build this without needing outside capital? When I was a founder, I spent so much time raising money, and all I wanted to do was work on the business and build the product. And so it was incredibly frustrating for me to do that. And tied to your point, you know, I think it is maybe not as bad as a lottery, and there is certainly, you know, a playbook out there for, you know, what do you need to do in terms of like increasing your odds of getting investor money. But I think trying to figure out how to raise without going to VCs or angels is certainly a good backup plan at a minimum. And whether that's government or whether that's crowdfunding, you know, those things still are challenging and time consuming and take away from actually building the business. So as much as possible, there's this amazing way to get money that is non-dilutive, and it is called revenue. And the way you get revenue is you provide value to your customers and they pay you for that. And so the more you can stay focused on that, the easier everything becomes. So I hope that answered the question.
Okay, our next question is from Jennifer. Jennifer, please unmute yourself and ask your question live.
Hello. So my question is regards to the timing of your round. What is the length of time you need to be prepared to dedicate towards a fundraising round from beginning to end? Is it 3 months, 6 months, 9 months? I'm just trying to get a feel for when I want to start fundraising and how much time I need to put into that particular round.
Mm-hmm. So from beginning to end, I recommend 6 months. So that is, saying, okay, I'm going to start fundraising. I'm going to start dedicating a good amount of my day or my week to those efforts until money is in the bank, legal documents are finalized, and I'm back to not fundraising. 6 months in total. Now, how much of that time is kind of, I mentioned at the beginning, you're either fundraising or you're not. So how much is that like really focused time on fundraising? It's probably more of like 2 or 3 months, I would say, of figuring out who the investors are, getting intros, following up, having those first meetings, having those second meetings. So like a lot of dedicated time. That whole process is, I would say, roughly 2-ish months. But one thing to keep in mind is that these things can certainly drag on. And so thinking about backup plans and kind of setting personal deadlines and being intentional about how long you want to fundraise is definitely something that I recommend thinking about before you even start this whole process.